Please be seated. We'll start the deliberations. A warm welcome to the distinguished panelist, Dr. Stephen Cochrane from Moody's Analytics, Chief APAC Economist, joining from Singapore. A warm welcome to you, Dr. Stephen.
Thank you.
And Dr. V.K. Vijay Kumar, the Chief Investment Strategist of Geojit Financial Services, joining from SBIL from our Pushpagiri Hall, and also the cohort of participants who are here representing apex banks like Exim Bank, Small Industries Development Bank of India, and also specialized financial institutions like India Infrastructure Finance Company Limited and ECGC, who are attending a leadership program, who are joining physically from this hall, and also the various participants who are online in this particular call. They will be keep on joining. So the timing we are given is 11:45 to 1:15. So over to you, ma'am, for the to take over the substantive part of the.
Thank you, sir.
Program.
Holiday season is on. We have festivals coming up. Christmas, New Year celebrations are there. But we have uninvited guests too. Looming inflation, risks, recessionary risks, and wars are there, which are holding us and having looking at it as we can see the grim possibility of rebound. We'll be discussing this all today. I welcome you for a very much need of the time discussion on global and Asia economic outlook. Ladies and gentlemen, we have experts in this domain with us to deliberate on it, and we are joined by our director, Sir, too. I request Sir to present the opening remarks.
Thank you, ma'am. Am I audible, Dr. Krishna Kumar?
Yes, sir. Yes, sir. Warm welcome to you, sir, and please deliver the introductory remarks for the welcoming the cohort of participants who are joined virtually as well as physically. Sir. Over to you, sir. You're audible.
Yeah. Good morning, Dr. Stephen Cochrane. Good morning, sir, and good morning to Dr. Vijay Kumar, Chief Investment Strategist, Geojit Financial Services. And good morning to all the participants, Dr. Krishna Kumar and other supporting staff members from the SBIL and all the participants in this panel discussion, including the cohort of the representatives and participants from the apex banks and those colleagues who logged in through digital means. Good morning to all of you once again. I used to hear a word VUCA so frequently 5 years back to represent the global economy and the world affairs. VUCA, all of you are aware that it stands for volatile, uncertain, complex, and ambiguous. Today, this word is already replaced by a new acronym, BANI, to represent the evolving business and political landscape globally. BANI stands for brittle, anxious, non-linear, and incomprehensible, which sums up to the myriad challenges the world is facing today. Contracting economies battered by the higher level of inflations across the world and geopolitical tensions are casting doom to the economic prospects globally. Before the world wakes up and heaves a sigh of relief from the pandemic, one more is awaiting facing a major challenge to the world. Economies are adversely impacted by negative expectations given the red flags that are visible across the globe. When policy initiatives by central banks ignore global perspective, I'm sure that it will imperil the global recovery. There is a need to align the monetary policy and structural reforms across the globe to improve the recovery prospects globally. Against this backdrop, we at SBIL, in association with a host of apex banks in India, are delighted to organize a hybrid panel discussion on global and Asia economic outlook with eminent panelists and share their thoughts on these slightly inscrutable trends, or the nuances of macroeconomy globally. I'm highly thankful to the panelists for sparing their valuable time and consenting to grace this panel discussion. Now I extend a warm welcome to Dr. Stephen Puchrani, Chief APAC Economist at Moody's Analytics Singapore. Welcome, sir.
Thank you.
Thank you. Dr. V.K. Vijay Kumar, Chief Investment Strategist, Geojit Financial Services, India. Welcome, sir.
Thank you. Thank you.
Thank you, sir. I'm sure that all the participants and audience will be immensely benefited by the deliberations of this panel discussion. I compliment and appreciate Dr. Krishna Kumar, our Dean, and his team for coordinating with such erudite panelists and roping in their services for this panel discussion. I once again extend a warm welcome to all of you to this panel discussion. Thank you. Thank you very much.
Thank you, sir. Thank you so much.
Sir. As it is rightly said, when giant economy sneezes, other economies all over the world catches cold. We have with us today our first expert for the day, Mr. Stephen Cochrane. Sir is a leading APAC economist, oversees regional economic analysis and forecasting. He presents the company's economic research and outlook and leads consulting projects to help clients assess the effects of these developments on their businesses. He is the chief APAC economist for Moody's Analytics and leads the firm's Asia Economic Analysis, Forecasting and Research. Based in Singapore, Mr. Steve leads a team of economists involved in research and consulting projects focused on near-term economic risk to Asia-specific economies, including the potential impact of tariffs, exposure of international capital flows, interest rate shifts, rising debt loads of households, corporations, and government. He was awarded as Penn Institute Urban Research Scholar. We welcome you, sir.
Well, thank you very much. What a pleasant introduction. I appreciate your very kind comments. Let me just double check. Dr. Krishna Kumar, can you hear me?
Yes, sir. Yes, sir. We are able to hear you. Yeah.
Very good. Okay. I have some PowerPoint charts I want to share, and I'm hoping I can do this on our screen here.
Yes. Just after the introduction of Dr. V.K. Vijay Kumar, also you can get started, sir.
Yes, thank you.
Okay.
Thank you, sir. We have with us Dr. V.K. Vijay Kumar. Sir joined Geojit Financial Services in 2010, prior to which he was working as professor and head of the Department of Economics at Sri Krishna College, Guruvayur, Kerala. He is currently the chief investment strategist of Geojit Financial Services. Dr. Vijay Kumar is well known for his articles on economic and financial issues and is a regular participant in discussions on economic financial issues on TV channels. As an academician, he has presented 76 national papers and 12 papers in international seminars. He writes in columns in ET Online. His articles appear in ET Money Control, The Hindu, and Indian Express, besides Malayalam publications. He is a resource person for Kerala, Calicut, Kannur, MG, and Kerala Agricultural Universities. Dr. Vijay Kumar has made presentations on financial planning, investment planning, wealth management, India growth story, India capital market, and related topics in colleges and universities all over India. He frequently addresses investors' conferences for new and as well as savvy investors. He regularly addresses students and faculties in colleges and universities all over India and topics of economic interests. We welcome you, sir.
Thank you. Thank you. Delighted to be here. It is an honor.
Now, I would like to introduce our moderator for the panel discussion, Professor Dr. Narayan Krishna Kumar. Sir is a bank executive turned academic leader trainer. He is currently Dean and Head of Academics at State Bank Institute of Leadership, Kolkata. He has nearly 3 decades of experience spanning banking, consulting, research, training, and academics. As a career banker, he has more than 15 years of progressive banking experience with varied profiles. He has exposure to both general and specialized streams of banking and has headed risk and treasury functions in banks. As an avid interdisciplinary researcher, he has published more than 60 publications in both national and international journals. He has served as a speaker in national and international conferences, workshops, more than 50 vocations, and in many platforms and forums like CII, FI, CCI. universities, etc., and has conducted more than 100 training programs in India and abroad. I request Sir to take over.
Thank you, ma'am. Yeah, so we will have the deliberations get started. So the format of this particular virtual or hybrid format panel discussion is structured in this way. We would, Dr. Steve, now you can invoke your presentations. Hope I'm audible. Yeah, please.
Yes,
go
yes,
ahead.
indeed. All right. Thank you so much.
By the time when you invoke, I'll just give an intro. So it will go like this. Dr. Steve will be presenting for about 20 minutes. As we all know that Moody's do a lot of research. He's part of the analytics wing. So let us hear from what is that they have to tell as far as the global as well as the Asian economy, and then we'll start the deliberations both with Dr. Steve as well as Dr. Vijay Kumar. So that's how the whole format will evolve. And I would also urge all the participants, now I find the number ticking up as far as the virtual participants are concerned, as well as here about near about 30 participants are there. So you can all have questions either in the chat boxes in the Teams link wherein you're joining, or physically here also. We will take up in the last 15-20 minutes a lot of questions as well. Okay, so that's how the whole format will evolve. So over to you, Dr. Steve, please.
Very good. Thank you very much. Let me see if I can successfully share my screen.
Yes, it has come.
And good. All right. And let me make this maximize the screen.
Yes.
Excellent. All right. So what I'd like to do in my 20 minutes is just give a brief presentation outlining my assessment of the global economy today, some very critical assumptions about the forecast going forward. I want to bring it down from the global level to talk a little bit about the Asian economy and present our forecast for the Asian economy, and then finally wrap it up highlighting some of the important risks to consider. This will be fairly high level, but of course we can go into much more detail as the conversation continues. So allow me to. Can you see the map that I'm showing here?
Yes.
Okay, so this is probably the best summary of our forecast for the next year. This is an indication of the probability of a recession over the next 12 months, so really through 2023, in each country that we follow closely around the world. This is put together by I and my roughly 80 economist colleagues around the world at our Moody's Analytics offices here in Asia, in Europe, and in the US. When we talk about recession, we're talking about a broad definition of recession, so not just simply looking at our modeled forecast and looking at whether we may get 2 quarters of GDP decline, but looking at a broad set of indicators, including labor market conditions, industrial production, trade, currency, inflation, and such. So a couple of points here. One, the gray countries are countries that we do not have enough data for to assess, just to make that point out in the beginning. Second, the dark purple colors are the countries that we deem in recession right now. And the key thing is that there really are not that many countries in recession at the moment. The obvious ones, for obvious reasons, Russia and Ukraine. And then a few in South Asia that are suffering from issues of difficulties in governance, such as Sri Lanka, Myanmar, or the massive floods in Pakistan that are holding the economy back there. But other than that, there really are very few countries in recession. But there are countries struggling and have a fairly high probability of recession as inflation rises, as industrial production falters, and particularly in Europe as costs for energy continue to rise. You can see that we have Europe mostly in red. That is the probability of 66 to 100% of recession. We do think that the probability is quite high that by perhaps the end of this month, next month, as the region enters the deepest months of the winter and costs rise due to high energy prices, costs for households, costs for industries, that the economy will begin to contract. Already we're seeing some downturns in Europe in industrial production and in consumer spending as a result of the high inflation and the expectation that costs will rise further. So the highest probability of a very near-term recession is in Europe. If we go to North America, we look at we have about a 56% probability of recession in North America. Canada, a little higher. The United States, we put at about a 50-50 probability of recession going forward. What keeps the probability elevated at about 50% is the pace of monetary policy, rising interest rates, and the fact that as monetary policy continues to raise interest rates, it could work to constrict the economy and pull the economy into recession. But on the other side, the U.S. economy actually is quite strong. The labor market is very strong. Consumer spending remains healthy. And even more importantly, business investment spending remains quite strong in the United States. So there is a fairly good chance that if the Federal Reserve can thread that needle, so to speak, as they're talking about slowing the pace of rising interest rates in December, although continuing modest increases in interest rates early in the year, then there is a possibility that the U.S. could avoid an outright recession and that the economy could essentially flatline for a couple of quarters before it begins to improve later in the year. Turning to Asia, you can see that there is much more green and blue in Asia. Those probabilities of recession are below 50%. India, Southeast Asia, Australia, all looking fairly good. The expectation is that the economies will slow, but these economies, the domestic economies, are still opening up, still recovering from the pandemic recession, and still benefiting to a certain extent from global trade, although global trade is slowing, and I'll talk about that a little bit later. And of course, one of the biggest risks is to China, and we have China at something over 50%, given all of the difficulties in the China economy today, and I'll talk about that in a moment as well. But this outlines the broad spectrum of recession risk around the world. And again, the highest probability of recession in Europe, and perhaps much of Asia having the lowest probability of recession. Now, a couple of key assumptions to our forecast, very, very critical assumptions. One is that oil prices will remain stable. And indeed, oil prices have actually fallen lately. The Brent crude is down at about $83 a barrel. It's actually not that far above its price before the Russian invasion of Ukraine. Our expectation is that it will remain stable as supplies that are lost from Russian oil due to import bans and sanctioning and such are made up by increased supplies from the U.S. And from strategic petroleum reserves and from taking from inventory as well in the very, very near term. Our expectation is that by early next year, perhaps in March, supply and demand will likely be balanced, and we can expect oil prices to remain stable through the end of next year. There is, of course, some risk there. There is been a lot of volatility over the last couple of days, given the sanctions that have been now executed by the European Union on the seaborne shipping of oil from Russia. Although prices went up, then they went down again. There's no guarantee that this volatility will end anytime soon. But that is one key assumption to the outlook. And the other key assumption to the outlook is that supply chain disruptions, particularly supply chain disruptions from China, no longer become a critical factor in generating inflation as they did back in 2021 and early 2022. These are indexes of supply chain stress that we calculate based on a number of factors around delivery times, freight rates, labor market conditions in the logistics industries, wait times at ports for ships, and the like. The supply chain stress has largely eased out of China. There's still a bit of supply chain stress in the US. That would be the green line here, largely because there are labor shortages in many components of the shipping channels across the US, particularly in the ports, major ports, and in many of the rail systems across the US. But largely speaking, we're expecting that this will not be a big problem going forward. The recent shifts over the last week in terms of zero COVID policy in China bode well for the continuation of easing of supply chain stress, and this also should not be a factor in terms of driving inflation higher going forward. So those are two key assumptions about the economy, about the forecast. Let me shift and just talk about the Asian economy, and particularly about China, because China means so much for the broader Asian economy, from South Asia down to Southeast Asia, up to the Northern Pacific, Japan, Korea, Hong Kong, and the like. And the key factor, of course, is that there are, as I mentioned at the top, so many weaknesses in the Chinese economy, illustrated here by the Purchasing Managers Index, which is below that neutral line of 50, and has largely been below that line, both the top line PMI and many of its components, ever since the middle of the year. And particularly lately, new orders have weakened. That's that orange line. And new export orders, the red line, has consistently fallen since the middle of the year, indicating a weakness in the manufacturing economy and the fact that the slowdown in the global economy has led to a lower order base for goods out of China. But the domestic economy leads to this weakness as well, because of the weakness in the property development market, the lack of construction activity, which the government is trying to prop up with a number of programs to provide liquidity to the industry and liquidity to households for mortgage borrowing. But there's little evidence yet that has had any influence on construction activity. I think it will soon, but not yet. So weak domestic demand and weak foreign demand, all leading to weak manufacturing activity and a weak service economy in China. And that means a lot for the rest of the Asian economy, because these indicators of trade illustrate that no longer are either exports or imports, the value of exports or imports, rising in China. The green line here is particularly telling. The green line is the value of imports, which hasn't risen over the year since March. So for more than 6 months, the level of the value of imports has not changed, indicating a very weak domestic demand for goods, and also weak demand from the manufacturing economy for intermediate goods that go into the manufacturing process that then flow into either domestic demand or to exports. But lately in October, the export pattern has also fallen. Exports in October were below 1 year ago, first time since the pandemic recession that exports fell. And again, an indicator of the weak external economy for China. And you can see it in India as well. Here, the blue line is exports out of India. Exports have been quite volatile. They were very, very strong earlier in the year, but have come down and are now down below that zero line, which means that exports in October were below where they were in October of 2021. And industrial production, again, was looking very, very good earlier in the year, but we see some disappointment now in terms of the pattern of industrial production falling rather flat over the year as of August, September, which is the latest date for Indian IP. So the influence of the weak global economy and the weak China economy is evident throughout the rest of Asia. Our forecast for GDP growth for 2023 is for GDP growth to slow across the region, really everywhere except in China, where we do expect some of the stimulus measures by policymakers to help get the Chinese economy back on its feet. But there was the first half of next year, there's still a lot of questions about how quickly that the economy in China can get back on its feet. And it may very well be the second half of next year before COVID restrictions are truly eased and production can come back into full pace that might be expected. You can see the Indian economy will be one of the fastest economies in Asia, but it too will slow from that very rapid growth in 2022 that illustrated the turnaround after the pandemic recession. I'll go quickly now just to focus on a few of the risks, and then we can move on to the discussion. One, of course, is that exports across Asia will actually decline rather than slow. And this chart shows how a number of countries are seeing their exports from their own industrial bases leveling off. These lines here, the orange, the red, the purple line, Taiwan, Korea, Singapore, and such, exports have slowed so that they're just about equal to a year ago. The only country where export pace is still very stable is Vietnam, which has probably the strongest connection to the U.S. economy. And I would argue the U.S. economy is probably the strongest economy outside of the Middle East at the moment. And then some slowdown in the exports of commodity-producing Malaysia and Indonesia as well. Inflation, of course, a big risk. We do see some signs of peaking of inflation across Asia. The left-hand chart shows economies of Southeast Asia, and you can see that in Thailand and in Malaysia and in Singapore, we may have reached a peak in terms of headline inflation, but it's not uniform, particularly the Philippines and Indonesia still rising. And then the larger economies, and we have India here. Of course, India has one of the highest inflation rates in the region. It seems to have leveled off, but has not really come down to any significant extent. It's been somewhat volatile over the last 4 or 5 months. Same with Korea. Korea seems to have peaked, but it has not come down. And other countries as well, lower, but rather stable in terms of Taiwan, Hong Kong, and China having rather modest inflation. So it looks like inflation is or near a peak. The risk, of course, is that we have this wrong and that inflation continues to be an issue. And we do expect that monetary policy will continue to rise. This is the monetary policy rate for a number of the major countries around the region. And we expect that most of the central banks will likely continue to raise rates through the early period of 2023, and then following what we expect will be a pattern by the Federal Reserve in the U.S., they'll likely level off and begin to pivot early to mid 2023. I must say we have for India a flat line on the monetary policy rate at 6%. We're working on a new forecast for December right now. We do expect that there will be another increase for India, given the fact that inflation has not yet come down. So going forward when we release our forecast next week. But this will put the brakes on the Asia economies as well. And one reason why 2023 will be a slower year than 2022. There is some, of course, pressure on foreign exchange. That foreign exchange pressure actually has begun to ease. This is the nominal dollar index, both nominal broad dollar and nominal dollar index versus emerging economies, the green line. You can see, of course, here, this is the dollar strength that followed the Federal Reserve's rise in the federal funds rate. But as the messaging from the Federal Reserve has shifted, this dollar strength has begun to ease. And this is a good sign for most of Asia that a lot of the downward pressure, the deflationary pressure on currencies may well have passed. There are three currencies that have not begun to improve over the last couple of weeks. One is the Philippines, one is Indonesia, and one is India, where the rupee still is very weak and has not yet regained some of what it has lost over the last several months. And finally, just to compare where depreciation amongst some of the economies in Asia have fallen, this is the percent change year ago of each country currency versus the US dollar. So, of course, in the weakest economies, Sri Lanka, Laos, Pakistan, very a sharp depreciation of currencies. Japan, then, amongst the developed economies of Asia, has the most currency depreciation. A few, though, have been rather modest. Australia, Thailand, Vietnam, even India, at about 10%, look better than, say, Korea, New Zealand, Philippines, and even better than the euro currency. So while currencies have weakened, I would say that Asia stands in better stead in terms of the minimal amount of impact from the dollar strength, as opposed to, say, some of the frontier economies elsewhere in Asia or in Latin America or in Central Asia. So the outlook is still modestly good for Asia. As I said, I still expect the conditions to slow, but I think that most of the major economies in Asia will likely avoid an outright recession in the coming year. But of course, there are risks in terms of potential inflation, supply chain disruptions, monetary policy, potential mistakes in monetary policy, and the broader picture of global trade. So let me leave it at that and turn it back to you, Dr. Krishna Kumar.
Thank you, Dr. Steve, for very nicely putting it in a nutshell, the global and Asia economic outlook born out of your research. So let us now kickstart the discussion. I'll try to elicit a lot of responses from the participants, both online. I find near about 80 to 100 people are getting tuned in online, as well as we are live in SBI's Facebook as well as in the YouTube pages. So we will we are live in all these formats, so we can take questions in all these formats. So just to keep the discussion going, thank you, Dr. Steve. Your research, especially when you prognose into the next 12 months as to what is the probability of a recession setting in. We noticed that this whole global economy, which is about 88 trillion or so, when we divide it into blocks of US and North America block, Euro block, and then the block of say Asia or Southeast Asia and things like that. Then the major economies. We noticed that the major economies, be it China or Europe, major part of Europe, and already the Russia and much of those are already in the recession. Now, the other part, the major economies in the Eurozone as well as in North America or elsewhere are also in the verge of it. About your prediction says about 65%. So the green areas are far too limited in that, except maybe India there, plus I could see a few green shoots in Middle East, maybe Saudi Arabia, Bahrain, Oman, and all this UAE and all, and then Australia majorly, and some of these obviously emerging economies in Asia like Vietnam and all. You had already referred about it. Now, my question to you, Dr. Steve, is considering the fact that the major economies are going to have a recession, can these green shoots or green areas that we see in some of these relatively smaller pockets, uh, can it move the needle of world economy going forward? Part one of the question. Part 2, are we going to be in this for a longer, is it going to be a very longer run recession as far as the world is concerned? What is your prognosis on these, sir? If you could summarize for the benefit of the audience who are tuned in. Because as we all know that when the quantitative tightening happened in the world, there is always a lag effect, the way the transmission happens. So, how is it likely to pan out, and is it going to be a long run recession? Is my question to you. Over to you, Dr. Steve.
All right. So I guess the easiest question to answer, all the green countries in Asia, India, Southeast Asia, down to Australia, can they make a difference in leveraging the economy to maintain growth through this period? And I think the short answer is no. They're not large enough to really drive the economy. They are, in a sense, more driven by what happens in other parts of the economy. The one exception might be India, because it is large and is driven a lot less by export demand and more by investment spending and consumer spending. And so India, in a sense, is protected a little bit from the broader trends. But it's really going to be, I think, up to what happens in the U.S. economy and what happens in the China economy, because it does seem that the European economy is certainly destined to fall into recession for at least a couple of quarters, given the high energy costs and the uncertainty in supply chains in Europe. So Europe probably can't provide the ballast, if you will, for the global economy. And then the question is really going to North America again, if the U.S. economy can avoid recession, and particularly if it can maintain a pace of consumer spending that is something close to what we're still seeing today. It doesn't have to be quite as strong, but that certainly helps improve demand for global exports, because so much of consumer spending in the United States goes toward purchases of imported goods. China, then, there's so many questions about the China economy and whether China can really get back on its feet. And the thing about China is it's not just one or two things. It's many factors that have to be addressed all at once. And in a sense, Chinese policymakers have kind of backed themselves into a corner almost, and it's very difficult to get out of that corner. So first would be trying to get the property development market back on its feet, at least so construction activity can resume, so that housing units can be delivered to households that have already taken out mortgages on those units, so that they will begin repaying their mortgages and stop the mortgage payment boycott, which sort of interrupts the whole financial flow within the housing system. So that ecosystem, if you will, of the housing market is critical in getting the economy going. And then, as I mentioned, also the zero COVID policy, I think it's going to be a slow slog in terms of policymakers figuring out how to exit out of zero COVID. I don't think it's a matter now of if they will, but when they will, given the comments that have come out of China over the last few days. But China has problems. They have a very low vaccination rate of their elderly population, which creates quite a bit of risk. They have a rather insufficient public health system, so that if indeed serious cases of COVID rise, as they learn to live with COVID, they may not be able to manage the the caseload. And then, of course, whether when and if they choose to actually open up the borders of the economy and allow free travel in and out. These are three different factors among many that policymakers have to face. The advantage of the Asian economies, particularly Asia ex-China, if you will, versus North America and Europe, is that at least when the inflation that was driven by high energy prices, which was caused by the war in Ukraine, when that all started, inflation was really very low in most of Asia, whereas it was already high in Europe and the US, because Europe and the US had already come out of their pandemic recessions. They had a lot of generous fiscal policy measures to pump income out to families or support employment and such. So inflation was already an issue in Europe and the US, say 1 year ago. And then high energy prices came along to compound that inflation, and that's what generated so much of the issue with the lack of control of inflation, and then central banks moving in to try to manage that. At least in Asia, inflation was low when energy prices began to rise after the war. So that inflation, even today, is still less of a problem. It is a problem, but is less of a problem in Asia than it is in North America and Europe. And as you can see, hopefully we're at a peak of that inflation, at least top line inflation in Asia. What central banks will be watching now across Asia is what's happening with food inflation, because of course food is an extraordinarily large part of the consumption basket in most Asian countries. And the cost of food is likely to remain higher because it takes longer for price increases, particularly for fertilizer and transportation and labor, if you will, to factor into food prices and then to ultimately stabilize and begin to come in. So I think food prices will be something that central banks around the world around Asia will be watching very carefully as they deliberate in terms of policy going forward over the next 3 to 6 months. You asked a question too about how deep or how long a recession might be. I think it looks fairly good that if we have a global recession, or at least recessions in some regions of the world, it might not be more than what we might call an ordinary recession or a garden variety recession. It may not be a deep, prolonged recession. One, because energy and commodity prices are coming down already. So that looks like it won't be an issue that will worsen a recession. Usually a recession, when you go into a recession, prices are still rising. Now prices are beginning to fall. So that's a good sign. Second, at least in the US, there aren't very many imbalances in the economy in the US. Household finances are fairly strong. Debt to income ratios are fairly low. Corporate leverage is not great. And fiscal policy seems stable, even if sovereign debt in the US is quite high. There's not a lot of moves to cut fiscal policy at the moment. So I think from a US point of view, I think a recession could be a modest 2-quarter something recession with a rather rapid turnaround. Europe will struggle a little more to come out of recession, again, simply because of the difficulties of energy prices. They may very well have difficulties going into winter of 2023, next winter, let alone this winter that's just beginning right now. So their problems could be extended a little bit longer. And so, broadly speaking, I think there's a good chance that a global recession may not be deep, may be a modest recession in comparison to, say, the financial crisis of 2008 or the Asian financial crisis back in the late 1990s.
Thank you. Thank you so much, Dr. Steve, for the exhaustive explanation. And it's good news that as Dr. Steve is prognosing, maybe this particular recession is not that long drawn. Now, that makes me to bring Dr. Vijay Kumar to the discussion. You know that now that India is very much in the limelight of the, well-performing, or rather in the green area of the larger economies. Still, the fact remains that when the quantitative tightening happened, about 0.75 increase from June onwards, 4 times continuously. That is enough to break the back of any economy, and that was also the case with the way it is transmitted in various economies. But fortunately, we noticed that in India there was a lot more a calibrated approach in the way the central bankers have responded. You could see that in various other economies also. Now, going forward, what is your prognosis, sir? The way we still had a transmission issue in the when they talked about the monetary policy. Plus, we also had a capital flow issue, though not severe. We had an exports issue, which is bit inconsistent. So, how was these things panning out as far as India is concerned? If you could throw more light on it, and in general, beyond that, India to the Asia also.
Okay. Thank you, Krishna Kumar. At the outset, let me thank Dr. Steve for that very exhaustive presentation. It was very heartening for us in India to see that very large green area in the map as represented by the Indian economy, where, as you rightly said, the probability of a recession is zero. One of the few green areas in the world where the probability of a recession is zero. And that is one area in which there is consensus. So thank you for that. Now, coming to your question specifically, Dr. Krishna Kumar, I think, as you rightly said, the RBIs and more importantly, the MPC's response to this quantitative tightening and a very sharp increase in the Fed funds rate. This is very abnormal, 0.75 percentage increase 4 times in a row.
Less than 6 months.
Yes, less than 6 months, and that too after being behind the curve for an extended period of time, because the Fed has been saying very consistently and rather surprisingly that this is only a transitory inflation and not a structural inflation, but they have been proved wrong. Then India's response have been calibrated and also a measured response, and I think the MPC has done well. If you look at and going by the data and the very interesting graph put out by Steve also, our inflation rate is much lower than the rest of the world. I have not come across any period. I've been observing the Indian economy for more than four decades now. I've never come across any period when India's inflation was lower than the inflation in the developed world, in the US and in Europe. Now we have a very interesting situation where our inflation is much lower than in US and the Europe, and then also in many other countries also. And in currency also, as your charts very, very accurately indicates, our currency depreciation is also much lower when compared to others. In fact, Indian rupee has appreciated against the yen, appreciated even against the euro, and perhaps the pound sterling also. There are only a few countries like Australia and perhaps Thailand and also Vietnam, a small economy, which have done better as far as currency depreciation is concerned. So our currency depreciation 10% in this very volatile and very difficult times is something of an achievement. But there are two factors which made this possible. I think I need to highlight that. The two factors which made this containment of inflation and containment of exchange rate depreciation are, number one, we had a very good foreign exchange reserves to start with. $630 billion of foreign exchange reserves. That was a pretty good cushion. And our central bank did a good job in actually accumulating the foreign exchange reserves at the right time. So from the $630 billion of forex reserves, we drew down $100 billion. It came down from 630 to 530. And the RBI did a good job of defending the rupee when there was an influx of capital outflows in India, when the foreign portfolio investors started selling in a big way. So our foreign exchange reserves stood us in good stead, unlike in our neighboring countries, many other countries which are now knocking on the doors of IMF for foreign exchange standby loans. So this is one factor which put us in good stead. And second is from the capital market perspective, I would like to share with Dr. Steve this very interesting development. I'm sure you also would have followed that. India's retail investors in India, the domestic investors in India have now become a force to reckon with. Formerly, when the foreign portfolio investors were selling in India, there used to be big crash in the market, currency used to depreciate, and capital outflow used to wreak havoc with the financial system. But during the last 2 years, I'm giving you the data till yesterday, till December 5th, not yesterday, till December 5th, the total foreign portfolio outflows from India from January last year to December 5th this year is around rupees 1,99,000 crores. Converted into dollars, it will be around $25 billion. So $25 billion is the capital outflows, what the foreign portfolio investors sold through the exchange in the stock market. But this selling by foreign portfolio investors have been completely absorbed by domestic institutional investors and also the retail investors. The retail investor, I've been doing a lot of work for spreading financial literacy in India for more than 2 decades now. But then this pandemic has contributed to the spread of financial literacy in India. Paradoxically, because our retail investor population, the demat accounts have simply exploded from 40 million accounts to more than 100 million accounts in 200 in less than let us say 2.5 years, from 40 million to more than 100 million. And also the money that is flowing into the mutual funds, that also is seeing very robust inflows. And our monthly SIPs, what is called the systematic investment plan, where retail investors are investing in the equity markets on a systematic basis, that also is touching records almost every month. So this is a very positive development where the domestic investors, domestic institutional investors and retail investors have become a sort of a counter force, a countervailing force to the foreign portfolio investors who have been leaving the Indian markets because of the currency appreciation. As we know, dollar appreciation has been the problem. But then the foreign portfolio investors have been, if I may use that expression, forced to come back to India, because India has been the best performing market in the world, best performing equity market in the world this year. So these two factors, India's very ample foreign exchange reserves and this paradigm shift that is happening in the Indian capital market in terms of retail ownership and domestic institutional investor ownership, these two factors have played a very important role in this stability that has helped the RBI also to have this measured response.
Good, good. Thank you for that exhaustive explanation. Now I'll again bring in Dr. Steve from the view of the inflation risk that we were talking about. The fact remains that though the inflation is becoming a big worry, and the kind of the way US is placed is slightly going to determine how things will pan out. What is your sense of the situation when you are looking at the global inflation, the way it is panning out, including the energy crisis? Of course, I could relate to your slide where you said, the war, Russian-Ukraine war, and the fallout of that. Those ill effects are getting countered in a measured way. But how do you look at inflation risk in the overall in the globe, as well as more of Asian and Southeast Asian kind of economies? Because there has been also, it is unfortunately during the same time that many of these economies had to borrow and need to take a lot of health, make a lot of health spending, which had sort of upset their finances to a level that many of them are equally in the brink. And when you look at the debt to GDP ratio, many of the economies, things have gone up like anything. The last 4 years data doesn't present a good picture of the debt to GDP ratio in many of these economies, especially the ones where more of currency depreciation is seen. So, how do you make sense of this particular aspect when we are looking at from the inflation risk point of view, plus the energy risk, the way it is panning out? Over to you, Dr. Steve.
So maybe to talk first about overall inflation related to the energy outlook. Again, it looks like we are close to reaching some kind of equilibrium in terms of supply and demand on energy. And again, it doesn't mean that we're going to see prices go down or that they're going to be the same every day. I mean, we've seen crude oil prices rise and fall by $5, $6, $7 a day. So there's a lot of volatility in the energy markets, depending on the news that's coming out of Ukraine, depending on the severity, or I should say how closely the sanctions, the EU sanctions, are actually being applied to Russian oil, and then of course how much Russia is able to get around those sanctions and supplying oil to other economies that will buy it on the outside of the standard markets. So, but if we think that we can see an average of say $90, even $95 a barrel of oil over the course of the next year, that's not a bad price for global oil. It's not a price that would increase inflation. And I think actually perhaps there is some risk on the downside in terms of oil prices, given that we are in the low 80s right now, which would help alleviate inflation a little bit sooner. But for so many economies where all of energy is imported, so there has to be plenty of foreign exchange in order to be able to keep the flow of energy coming into the country. This is problematic, and this is then also leading to higher debt and instability in terms of financial conditions, particularly in the smaller economies. If you think the smaller economies of South Asia, the smaller economies of Africa, some of the economies of Central Asia as well. It's less of a problem in the Asia Pacific region, simply because, much like in India, there were ample foreign exchange. There have been and continue to be ample foreign exchange reserves in almost all of the Asia Pacific region. And now that the domestic economies are accelerating, and things they seem to be back on their feet. Conditions seem to be improving in terms of the region, in terms of foreign exchange, and in terms of GDP growth. So we do actually see in much of the Asia Pacific region that the debt to GDP ratio declined in Q1 and Q2 actually of this year in every Asian country except for China. And that's partly because the Chinese economy has grown so slow. So that's, the denominator of that debt to GDP ratio, of course, is GDP. Without the growth, without any GDP growth, the debt to GDP ratio stays high. But then again, China has plenty of resources in the near term to be able to deal with that. So that's not an existential problem for the Chinese economy. Now, ultimately, it will be. I don't know when. The debt to GDP ratio in China has been rising for 10 years. At some point, it has to come in, but not quite yet. But again, it is a real problem in some of these smaller frontier economies that don't have ample foreign exchange reserves still today. Of course, we can see it in Bangladesh, in Pakistan, Sri Lanka. Those are, I guess, the clearest examples in South Asia of where there are difficulties. But then also, if you look in parts of Africa and parts of Central Asia, and even in Latin America, there are some risks, maybe not of sovereign default, but certainly there may be a need for more countries to go to the IMF to get some additional funding to help support foreign exchange in the near term to be able to continue to bring in relatively high cost fuel and other imported goods that are required.
Thank you, Dr. Steve. Yeah, now, that makes me, need to perhaps take the discussion slightly onto the keel of manufacturing. And when Dr. Steve was presenting, we noticed that how China has sort of vacated that space of being the manufacturing hub of the world, and how other economies are still not in a position to sort of, fill that gap. There is still, even India is concerned, we are having a lot of supply chain bottlenecks and so on and so forth. Plus, somewhere along, the lackluster performance has been very clearly attributed to so many reasons, maybe so many markets, there's different reasons as well, including some things to do with the energy crisis as well. Now, coming to the aspect of Indian economy, we always know that whenever energy crisis happened, Indian economy's position was a bit wobbly, and historically that is how it has panned out. Now, coming to the, though we are at a time where there is a lot of sustainability related investment. We talk about renewables, we talk about EV, we talk about so many such ecosystem, which perhaps going forward is going to limit our, sort of bring down our dependency on more and more of oil. So, does it all give us any comfort, any kind of, the R&D orientation that companies have? Many of the companies are working towards net zero standards and so on. You know about it. So, is it all giving any kind of comfort to the Indian manufacturing, the way when you prognose into the future? And of course, there has to be a lot more of R&D and other things. And it's at a time that India has, donned the G20 presidency also. So, how is it all going to pan out as far as India is concerned? Your take on that?
It's a very big question, multi-dimensional. I will try to be brief and give you a multi-dimensional answer. Well, your first observation regarding the critical role of oil in the Indian economy, you're right that during all previous oil shocks, Indian economy had been impacted mainly through the current account deficit, because whenever we are dependent on crude oil imports to the extent of around 82%. So whenever crude shoots up, our current account deficit widens, and widening of current account deficit means depreciation of currency, imported inflation, which puts the central bank in a spot as far as monetary management is concerned. So that was a little bit scary last year also. I mean, not last year, this year. We are towards the close of the year, but immediately after the invasion of Ukraine by Putin, I would like to put it that way, rather than the Russia-Ukraine war, which is the euphemistic presentation. Immediately after that, crude skyrocketed to $135, Brent crude, $135. And that was a little bit scary because India's finances are to a large extent dependent upon this huge imports. And since we are growing impressively, likely to be a 7% GDP growth this financial year for India, maybe even if it is low, it will be only 6.8. It will be 6.8%, still the best among the large economies of the world. So with that kind of growth, our demand for diesel, petrol, aviation, turbine fuel, all these are continuing to be very, very high. So that is putting pressure. But there, right now, as Dr. Steve also has very clearly pointed out, crude is softening. And this morning, I was first thing that I look up after getting up is to the commodity prices, the bond market in the US. They're only the equity markets because the crude oil prices are crucial. And this morning, it has dipped below $84. Brent crude is below $84. So that is indeed a very heartening thing. And if the recession gathers momentum, suppose we have a short and shallow recession, which Dr. Steve is saying is the likely possibility next year, a short and shallow recession lasting, let us say, 2 quarters. a garden variety, as you rightly said, then it is further possible that crude can again come down. So, but then we are even now the war is on, and during a war we don't know what will happen. Suddenly it can take a turn for the worse. So if crude again goes up beyond $100 a barrel and stays there for an extended period of time, then our current account deficit can come under pressure. That is an area of concern. Now, of course, we are trying to address this problem from a longer term perspective. Some of India's large companies are investing hugely in renewables. Some large companies are investing very big in renewables. Big investment is happening. So that will reduce our dependence on, and also the EV space, the new ecosystem, EVs based ecosystem, that is also emerging very strongly.
Even to some extent, there is a kind of view that the digitalization per se is going to benefit. We talk about fintech and so on and so forth. The way it can radicalize so much and create so much saving for the energy is itself a brainer to go for it.
Oh yes, certainly.
Yes. So,
certainly, yes. Certainly, our this focus,
because our entire digitalization focus is on the grassroots when we talk about ONDC or TBDC the net. So all this.
That's right. And that is why the leading experts are projecting this as our UPI interface and the ONDC as a model worthy of emulation by other developing countries of the world. So that way, in the medium term, of course, we are in the right direction. But in the short run, there can be problems. But we are not like other countries where they have a sudden increase in the price of oil can impact their financial stability. In India, our financial stability is still strong. And your last point was, let me make a very brief remark about that. India's assuming the G20 presidency. Our Prime Minister is very optimistic about that. And the theme for the G20 presidency is one Earth, one family, one future. And that this is an extension of India's philosophy of Vasudhaiva Kudumbakam. And this is something very interesting. And our Prime Minister also has said that India's presidency of G20 will be characterized by inclusiveness. It will be action-oriented and decisive. These are his words. Let's hope it will pan out that way.
Sure. So nice. And just, that makes me take the questions further on to the trade part. The presentation very clearly established how the global trade has again not performed to the optimum. Now, we have a whole lot of bankers here representing policy level institutions like Exim Bank, SIDBI, and so on. So I would urge you to ask questions as well, but I'll just put the first question to Steve. Sir, we know that when the WTO mechanism failed, countries have started going in for more and more of free trade agreements. And India is, had a history of a lot of free trade agreements, and there was a lot of lull. Now again, we are very much into a lot of free trade agreements with be it Australia, UAE. In fact, many of the green area nations I see, India is trying to engage more and more. So these kind of free trade agreements, plus the way the logistics part is not that much hindrance you have made out. So how this is likely to bring back the trade element back into the global economy? If you could highlight that on your take on that, sir.
Yeah, I think trade is going to be a critical element in terms of recovery and long-term growth once we come out of the current lull in the global economy. I actually think that the number of bilateral trade agreements, or the way the bilateral trade agreements have become more prevalent than larger multilateral trade agreements, actually could slow down the pace of trade, because it's just one country versus another country, and you've got many different negotiations going all at the same time. Whereas if there was a return to more multilateral negotiations, say along the lines of the TPP or something like that, that you can bring more countries into a broader trade agreement and help to establish the rules and support, the fundamental precepts of the WTO. But having said that, one thing is pretty clear, and that is that in the short term, trade will benefit from the movement towards easing up or limiting concentration risk, if you will, if I can use that term. And when I say concentration risk, it largely applies to the high concentration of supply chains in China. And there already is a bit of a shift in terms of directions of direct foreign investment. Not that direct foreign investment is leaving China, but that it is becoming more evenly distributed around the world, and particularly in India and in Southeast Asia. These are places where we've seen some improvements in foreign direct investment. Because, in fact, I really did. I found that Dr. Vijay Kumar's comments on investment and that domestic investment was very strong despite capital outflows. But direct foreign investment in assets in India actually have improved as technology companies and manufacturing companies have found India to be an alternative to, say, China as a production location. And the same thing in Vietnam, in Cambodia, Laos, Malaysia, Thailand, Bangladesh. These countries have all benefited from improvements in foreign direct investment, which means that trade will become increasingly important for them as they become linked into various supply chains in different industries. So I think the more that economies can accommodate this shift in foreign direct investment and accommodate this diversification of supply chains and this getting away from the concentration risk of having all your eggs in one basket in China, that certainly will benefit the region and will solidify the need for open trade, for a trade that has very few hurdles in terms of getting in and out of borders, across state lines, and so forth. And this bodes well the more there is easy electronic transfers, electronic communications, and you talk about finance becoming available either to small producers, individuals, through e-commerce. I mean, this will benefit the entire production chain, from individual small entrepreneurs to large companies around the world, as they can speed the flow of information. Information regarding supply chains, incredibly critical. Information regarding financial flows, incredibly critical. And the greater we can get open digital commerce across borders to facilitate this trade, the better. I'm afraid I've rambled a little bit on that, but I think it does offer a lot of opportunities over the long term.
Thank you, Dr. Steve, for the explanation. And I could see a question in the chat box. I would urge many of the other participants who are here, as well as those who are tuned in, to ask questions. I'm taking one question from one Mr. A.B. Rajendra Prasad, directed to Vijay Kumar sir. What could be the impact of Indian IT due to a recession in US and Europe, which are major contributors for Indian IT economy?
This is a concern now. That's the reason why, if you look at the index of IT index now, this is one of the poorly performing index now in India, where the market always discounts the future. But then if you listen to the CEOs, the top people in the Indian IT companies, TCS, Infosys, Wipro, HCL Tech, they say this is a concern, but it has not yet reflected in the ground reality. orders continue to flow because there is this trend of digitalization and migration to cloud happening even in small business. Therefore, till now, this concern has not translated. The market is a little bit concerned about that, but the growth is very impressive this year also. But if the US goes into a recession, and I'm in the camp that believes that US has the capacity now, the strength to do a soft landing of the economy, because if you go by the labor market conditions and the employment generation in the US, last month 263,000, much higher than expectations. So a soft landing is something which the Fed might succeed. In that case, Indian IT will continue to do very well. Okay. They will continue to do very well. There need not be any concerns, but the medium to long-term prospects of Indian IT industry is extremely bright. Okay.
Thank you. Any questions from our audience here? You can unmute, just that pink portion you touch, it becomes green, and then you can ask, please. Yeah, go ahead.
Like,
you can introduce yourself and go ahead.
Considering the SMEs, when they want to invest in their capex,
okay.
I'll talk of capex only. Many of them are importing machinery. Okay, and right now, because of the dollar appreciation as well as the supply chain constraints, they are in a fix actually. Many of them have held back their kind of investments. So how long, say, what could be the forecast in, say, in the Q1 of 2023 regarding how would the dollar hold or the rupee hold vis-a-vis how the fluctuation would
the question is directed to me,
please.
Okay. Well, that depends a lot on how inflation in the US will pan out going forward. That is the most important thing. Dr. Steve also mentioned this particular point. There are indications that US inflation is coming down. The last print of inflation shows a downtick, but we do not know whether that downtick will sustain. If it sustains, then certainly the dollar index, you might have observed that the dollar index had gone beyond 114. This morning it is at 105. And if things normalize, it can again go down. So if the dollar index goes down and foreign portfolio investors continue to invest as they have been doing last month and also this month, then the rupee can slightly appreciate. Remember, rupee had crossed 83. Now it is 81.50. So a lot depends on capital flows, inflation in the US, and the Fed's monetary stance.
Very good. Any other question? Please, go ahead. Introduce yourself.
Sir, I'm Sudhir.
Yeah.
Sir, don't you feel that this inflation part of US and India will also be beneficial for Indian rupee in long term? Because inflation is high there relative to India. So here only our currency depreciated because of demand supply part of market part of things. But fundamentally, we are in a better position, or henceforth the depreciation will be less.
So that question is for me, or?
Yeah, you want to direct the question to Dr. Steve? Or
yeah, Dr. Steve.
Dr. Steve, please go ahead, Dr. Steve. Yeah.
Sure. So this is a question really about the direction of the rupee and whether there might be further depreciation, if I understood it right. I think the key, and Dr. Vijay Kumar mentioned this, is really what happens with Federal Reserve policy and dollar strength, because so much of the depreciation around the world of foreign exchange has less to do with local fundamentals and more simply to do with capital flight to the US dollar. And there's a good chance that we may see an end to this deflation pretty soon. And in fact, in a number of, as I showed in a number of countries, the dollar already has begun to weaken a bit. And that is due to right now, simply the indications that the Federal Reserve is giving of the direction they're going to go on policy, that the 75 basis point hikes are over, that there might be a 50 basis point hike in later this month. And actually, we're projecting that it may be the Fed may put in a 25 basis point hike in January, and then maybe another 25 basis points in March. So the Federal Reserve is slowing its pace of tightening, but still getting to a terminal rate of somewhere around 5% on the federal funds rate. But that slowing of the terminal rate, a slowing of the tightening, will help to reduce the gap between interest rates in the U.S. and interest rates in India and other developing economies, and should mark the beginning of some improvements in terms of foreign exchange across the world. And again, not so much because of local fundamentals, but because simply that the strength of the dollar would begin to ease as capital flows begin to either slow into the U.S. or finally begin to reverse and head back to other countries. So the next 6 months will be critical, of course, and it depends on whether inflation does remain at least headed downward, where the Fed can be convinced that the inflation rate in the U.S. is headed back towards their target of something around 2%. If they're convinced of that, then they'll hold the federal funds rate level once they get to that terminal rate, maybe sometime in March. But of course, if inflation accelerates again in the U.S., then all bets are off. The Fed could continue to raise rates beyond that 5% rate.
Yeah, thank you, Dr. Steve. And there's one more question to you put in the chat box by one Mr. Ranjan Kumar Sahu. Steve, what is your perspective on emerging role of BFSI, particularly in India? Will the sector be bolstering a hyper growth, keeping aside at the recession altogether, since it is only 1/3 for India?
And I'm sorry, BFSI, I don't understand that term.
Yeah, BFSI, banking, financial services, insurance.
Oh, I'm sorry. Very good. So
because India is a lesser financialized economy, so possibly is that 1/3 observation is emanating from that. Yeah.
Right. So in the near term, I think banking and financial services will have a difficult time everywhere in the world as the yield curve either flattens or, as it is right now, it's a bit inverted, right? So banks are will have a hard time for a while because of the inability to borrow at a low rate and lend at a high rate. And that will affect banks all around the world, and both large established banks and even more so smaller banks or fintech companies just beginning to start out. It could be very, very difficult. I would expect the next year for fintech could be very, very difficult. Longer term, though, I think the outlook for financial services broadly is quite good. There's such a need, particularly amongst developing economies, to expand financial services to every corner of the population, to have everybody banked, and it's very clear that even small loans to individuals in the aggregate, when you add it all up, can be very, very profitable, and banks can do very well simply by expanding so the industry, so that everyone is part of the financial system, so nobody's left out. And indeed, there is a large share, of course, in all through South Asia, a large share of unbanked population. And then the potential for investment in terms of R&D and new technology, elements of the economy related to the environment, to alternative energy sources and such, actually I think is great in this part of the world because there's not as much installed capacity already in terms of infrastructure versus, say, in the U.S. or in Europe, where you've already got a large installed capacity that has to be replaced. It's very expensive, but you have less installed capacity, much more to develop out from scratch. You develop out from scratch with new technology, and banking, of course, becomes a critical component of providing the finance for that new technology. So I think, longer term, once we get beyond this current business cycle, the outlook is quite bright.
Thank you. Thank you. There is one more question to you, Mr. Steve. This is from one of our, I tend to believe from SBI only, GM of IT Special Projects, who's asking, Mr. Steve, what may be the impact of cap on Russian oil price on the overall economy?
The price cap that's just gone into effect.
Yes.
This is really hard to know. I will be perfectly honest. It's hard to know how well it can be enforced. It's hard to know how well Russia is able to get around those price caps and supply other markets. So I think we kind of have to wait and see how it goes. It does look like right now there's fairly good buy-in among the European Union to enforce these price caps.
Okay.
But so the will is there, the ability to enforce the price caps, I just don't have a good enough read on to understand. So I think that maybe my answer is there's a lot of uncertainty, and it just remains to be seen what that impact will be.
Thank you. Thank you. So we are left with hardly about 5 to 6 minutes. Any questions, please put it in the chat box. By the time I want to, yeah, please, go ahead.
Good afternoon, everyone. I'm Amita from Exim Bank. So this question is to Mr. Steve.
Please.
US being the biggest economy in the world, and their capital markets are very strong. One of the reasons is primarily that they are the reserve currency of the world. Now, given the fact that Russia and China, they are trading in their own currency, yuan or ruble, they're trading in that currency. And BRICS is also proposing to have a common currency. And in addition to that, Saudi Arabia is trying to get entry into BRICS. So given all these dynamics, how do you see the change in world order taking place, or whether it will take place or not? Maybe the first question, and whether it will, when it will happen?
Yeah, understood. So basically the de-dollarization. Please, over to you, Dr. Steve. Yeah.
Great question. I do think that, in a sense, the de-dollarization or the decoupling of the economy, or the diversification of global currencies, if you will, poses a fair amount of risk for the global economy, because one, it's uncertain whether one or the other will certainly maintain its value. And more importantly, that trust in those currencies will remain. This is such an important factor in terms of which currency or how many currencies can be the global currency. I would still, and here I must apologize, I am an American, but I don't want to allow that to color my thinking. But I still believe that the most fundamental support for the dollar as the global currency is the rule of law in the U.S. That supports investment, supports property rights and such. We don't have that in China. We don't have that in Russia, and less so in some of the other in some of the BRICS economies as well. I think that probably is the fundamental advantage of the dollar as being the global currency of record, if you will. That probably gives it some time to run in terms of the being the global currency. I'll leave it at that.
Yes, thank you, Steve. And I want to ask one question. By the time you can keep any reserve questions with you to Dr. Vijay Kumar. The whole scheme of, now that there are a lot of participants from the SBIL and MSME sector, when the entire thing panned out, the current way, the post-pandemic situation, the formalization of the economy has gone up like anything. And many of the MSMEs are still not able to figure out or talk about digitalization, aping onto the lot of high-tech gadgets. A lot of said than done as far as an MSME is concerned, isn't it? So, how is this going to be, tackled in the way India is going to position itself going forward?
Well, this is one area of concern. Our MSMEs has been the pillar of support for the economy in the sense, if you take the contribution of MSMEs to GDP, their contribution to exports, and also in the contribution to employment generation, that has been a pillar of support for the Indian economy. And even before the pandemic, with the ushering in of GST in India, MSMEs started, particularly the MSMEs which thrived on tax arbitrage. They started facing the heat. I think going forward, we will have to look at MSMEs in two different compartments. MSMEs which survived in the pre-GST era, prospered in the GST, pre-GST era, on tax evasion, non-compliance. They don't have any future at all, because we are in this world of compliance, and our tax reforms have ensured that such MSMEs will not progress. But then there are other segments of MSMEs who have a very bright future. Recently, I read an article in which I was really surprised to know that in a mobile phone, there are more than 300 parts in a mobile phone. And India is now becoming a major hub. Today's Economic Times headline news is about India's export of mobile phones. It is likely to be $9 billion this year, from $5.8 billion last year. And the target is to, I was taken aback, $60 billion by financial year 26.
5G so the world will prop it, because there's a lot of important.
So we are talking about a tenfold increase in mobile phone production, and Apple is going to, as a part of their China plus one strategy, shift the production base. So if we have MSMEs which are catering to this kind of production, where explosive growth is possible, this is the areas where our MSMEs also should focus, rather than relying on tax avoidance and avoiding compliance.
Absolutely. Well said, sir. And we have run out of time. Only one question, please. Please. You also want? Okay, only two questions allowed. Okay. Yeah, I'll give a chance to you after that. You go ahead, please. Yeah. Indian exports. Yeah, please.
Question. Yeah. So if you look at the performance of Indian economy, two factors are very, very significant. If you look at the growth of Indian economy, the impact of recession, the impact on exports, etc., two things are very, very clear. One, India is doing well. India is the fastest growing large economy in the world. But then, even though we are strong and growing at 6.87%, we are not completely immune from a global economic slowdown. So a global economic slowdown, particularly if it is a sharp economic slowdown, that will impact India's exports also, because there has been the correlation. And if there is a recession, particularly in the US, then that will be contributing to global economic slowdown, and that will hit the exports also, because there is a correlation between global growth and international trade and India's exports and international trade. So particularly, one pillar of strength for Indian exports has been IT. And if there is a US recession, Europe is already on the verge of recession, and there is a high likelihood of the Eurozone slipping into a recession. But if the US also goes into a recession, it will be impacting India's exports, particularly the IT exports. But that will be short-lived. I always look at the market. What are the indications from the market? The market message is that market has already discounted a short and shallow recession, but not a long and a deep recession. If that turns out well, things will be back to normal within 2 or 3 quarters.
Yeah, over to you, Brother OTS. Last question, please. Yeah.
So my question is this. The regional trade blocs like NAFTA and free trade associations Don't you think it is against the very principle of WTO's non-discrimination and the most favored nation concept? Is it not affecting our competitiveness? What is your suggestion to resolve this issue as it is affecting India's exports?
Dr. Steve.
Yeah, I think that I think it is in the best interest of India to try to enter into as broad a free trade agreements as possible, actually, so that there is a flow of trade coming from whatever direction it may come, whoever is producing what that is needed in the Indian economy, and to try to move away from any kind of protectionism. I think, again, the idea that, Dr. Vijay Kumar mentioned that firms need to be investing and producing for demand in the sectors that are growing quickly. And he mentions the mobile phone industry, rather than trying to hide behind protection or some legal wall. So the more open trade, I believe, actually, the better it is. Ideally, it would be through WTO. The WTO is not functioning as it used to for a number of reasons. And certainly, I think among policymakers around the world, one of the best things that can be done is to work towards improving the functioning of WTO, improving the dispute resolution body within the WTO that has been in sort of frozen for a number of years. So in my mind, that would be the best way to go. Without that, entertain broad trade agreements as broad as possible.
Thank you, Dr. Steve. So we have only time for the final observations to both the panelists. So I'm just taking the first take on Dr. Steve. As an analyst, economist representing Moody's, what is your take on the two major factors of this global macro story to look for this year, Dr. Steve? Over to you.
Well, I think still the key factor is inflation, and whether inflation truly can be brought down. Without inflation being contained, I think that it just adds so much to the uncertainty of the outlook. And that uncertainty of the outlook would come then from monetary policy, that the longer that inflation continues to be a problem, the greater potential for what I might term policy error on the part of central banks. In other words, being simply encouraged to continue to raise rates higher and faster, having no other alternative to try to contain interest. And then that is, of course, when ultimately the high interest rate costs, the high cost of capital forces economies into recession. And that would be a deeper recession than what we might expect right now, given where monetary policy is right now. So really, inflation and monetary policy, these are the things that I think everyone has to keep their eye on very, very closely.
Thank you, Dr. Steve. Inflation and monetary policy, two aspects. Yes. Now over to you, Dr. Vijay Kumar. When we have been discussing the entire aspect of global economy, Asian economy, Indian economy, and all. Could you just highlight three aspects of the bulb-on aspects of Indian economy which you want to flag to our policymakers?
As a proposal to the finance minister?
Whatever. No, in any case, finance minister, he is consulting a whole lot of economists. We are in the verge of the next budget. So already a lot of consultation is happening. So why not this also?
Okay. Thank you. I don't know whether the message will reach her, but my first suggestion would be to focus on fiscal consolidation. Of course, COVID is almost behind us. And as a part of the fiscal stimulus that we implemented, we had to expand our fiscal deficit. And that was the need of the times. But then a high fiscal deficit now, this year's target is 6.4% of the GDP. And with the kind of tax buoyancy that we are having in the economy this year, thanks to the tax reforms, we will achieve the target of 6.4% of the GDP. And our medium-term target is 4.5. And the finance minister should not slacken this fiscal discipline and fiscal consolidation, because if the fisc goes beyond levels of safety, then the fiscal deficit will spill over to the external sector and aggravate the current account deficit with all the attendant problems. So the first priority should be to bring the fiscal discipline back, and not to diverge from the medium-term fiscal consolidation map. A second suggestion would be, even though we have gone a long way in tax reforms in India, particularly in indirect tax reforms, the GST, and also in direct reforms in particularly in corporate tax. One of the very good things that the government did was to cut the corporate tax rates, which is a very good fillip to capital formation in India. But some more work needs to be done in personal income tax also. I would personally, I don't know whether my friends will agree with me on that. We should move towards a no exemption regime. We have brought in as a separate regime now, a no exemption regime that can increase tax revenue and tax compliance also. Of course, by raising the exemption limit. And some more tax reforms are required, for example, in capital gains, even though the tax the system has become far more simple than what it used to be. Take capital gains tax, for instance. Even now, it is a very complex maze of a lot of uncertainties. For example, we have got short-term capital gains tax, we have got long-term capital gains tax, one capital gains for debt, another capital gains for equity, capital gains with indexation, capital gains without indexation. This is one area where some more rational thinking and simplification is required.
Thank you. Thank you. So, with the last observation from my side, in fact, there's a globe here. So I was just watching what is that green shoot as far as the Africa is concerned. It is basically Tanzania, Kenya, and Algeria. The green spots, just for your understanding. Okay, so I was having a global map on, Thank you, Steve, for that. And, the masterly erudite panel is thanking on the behalf of State Bank Institute of Leadership. Thanks a whole lot, Dr. Vijay Kumar, Dr. Steve, and also for our director, Mr. Bangaraju, for welcoming the gathering, and all those who participated here from the cohort of participants representing 4 different banks and financial institutions, as well as all those who participated in the virtual format. So thanks from our side. So we'll be keeping on engaging in far more useful themes as we go forward. So this has been our commitment to the alumni who had gone through our portals, and we never charge them. So we just share them links and they come on board. I'm sorry that some of the questions I couldn't take up. I was seeing in the chat box. So since we have totally run out of time, I've already run out of time by more than 10 minutes. So it's over to you, ma'am, for the closing remarks. Yes.
And to all the participants for attending, directors and deans for making this event a success. Also to our support staff and
thank you. So thank you, Steve. Our on behalf of our director, we are also want to see you physically next time here.
I would love to be there. Thank you.
I know. Last time itself you had committed to us, and sorry that I was going to a few other summits, so I couldn't touch base with you. Maybe if I had given you a longer rope, you would have been able to come to Calcutta. So that invite is always open. So please do visit us. We'll have far more engaging discussions going forward.
Thank you.
Thank you. Thank you.
Thank you very much. Thank you, Dr. Steve. We will be privileged if you could make it to SBIL. We will look forward to your presence here. Thank you, Dr. Vijay Kumar. Thank you, sir.
Thank you. Thank you. We can announce the recording can go off now, and For the cohort of participants, what is the next thing you have, please? You can now. Yes, hard-earned lunch. Yeah, please go ahead. 250.
Thank you.